row. There is a new Fed chair, and you guys have been pretty active on Twitter and LinkedIn with your comments on rates and stuff. But let's just start with new Fed chair Marsh. Like, what's our perspective? What's happening? Go. You're there. Go. Comment.
I'll start. I just think it's great. I think with the new working committees that he set up, 5 different committees to look at different aspects of the economy and even things like communications. I think that he's already talked about expanding their data set and what they can consider. And I think with things like trueflation, I certainly refer to that a lot. I think it's got kind of a new and more up to date, so to speak, way of looking at things and economic data. I think the idea that we were kind of caught in this almost like a rut where everyone would hinge on the Fed's next announcement and what they were going to do next and what their move would be, even despite what the data might have been, or how you're going to incorporate all of that into one next meeting or one announcement. I think it almost made the market kind of a little bit too susceptible to just what would happen there. And so Warsh, I think, is trying to say he was already pretty clear about kind of minimizing the amount that they broadcast out there, but at the same time, they have a working committee on communication. So the way he described it is wanting the market to figure out, where rates should be. And I think that's just a really great approach. Interestingly, I don't know that it's going to necessarily deviate, like we're going to have some brand new dynamic in the market. Maybe it'll be the same ultimate conclusion that, we stay the same or we hike a little or whatever. But I think the fact that they're talking about expanding all these considerations and looking at it, hopefully in different ways, in ways that fit, the new technology, availability of data and all that stuff, I think is fantastic. And you kind of wonder why, if he's got these 5 subcommittees, well, what are the other governors for, or the members of the Fed there for? And so you kind of think, well, it'll be interesting to see how he overlays all these things and gets the parties to work together. But I think at the very least, you can say, especially given the diversity of opinions that he has in terms of their politics, where they served, all those things, or what administrations they served, all those things, I think it at least shows that he's willing to listen to a broad array and he's not just going to rubber stamp anything. So I like it. I think it's really exciting.
Garrett, let me ask you, we sit here today that the 10 years at 4.56, it's up about 2 basis points or so. The 5-year or the 10 years moved around, spreads are a little bit tight. What are you kind of seeing from a macro perspective as it relates to interest rates as a whole?
I mean, the market is definitely split. You listen to the news for 20 minutes and you'll hear, half the people who are like, oh, we're gonna have to hike, and half that are, Fed, cuts are coming. And that's probably a sign of a pretty healthy market. I would say Warsh is perhaps secretly more focused on the 10-year than short-term rates. I mean, obviously he is obligated to ensure price stability. But part of the Trump mandate and investment mandate is to get long-term financing for the U.S. down and to get the mortgage rate down, and all those are driven more by the 10-year than where the Fed funds rate is. And so Warsh has come out pretty hawkish, at least in his rhetoric, and I think part of withholding that information in the future, what the dot plot and where the Fed's going to be down the road. Is hopefully a way for them to bring down inflation concerns going forward, and that's what really would move the 10-year. That would help a lot of things. It'd help housing. We could push, and we've been refinancing the U.S. debt in the short term, and nobody wants to do that, Besson especially. And so also the dollar's very strong. So there's a lot of things that's making it difficult for us to finance long term, and I think that's secretly what Warsh is after, and so I think at 456, there's people make some decent arguments with the numbers today about having to hike in the future, but I totally don't see that. I mean, things lag, and certainly the U.S. consumer is showing signs of cracking. All the cash that they got during COVID, they've spent, and now they've borrowed They've racked up debt, savings down, debt's up. They're running out of options. They're going to have to start becoming sensitive to price. While we have a strong labor market, we don't really have a lot of wage growth. And so, like I said, they're running out of options. They're going to start getting picky. And I think that's coming pretty soon. We'll start to see the numbers come down.
Yeah. Well, let's transition. So you